Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun. I'm sitting here, it goes live, and the microphone's not in place, and I'm like, what the heck, guys, what are you doing? Oh, and then I'm like, I'm the only person that's responsible for this not being in the right spot. Okay, we got CPI data today, guys. Big deal. Really big deal. They're expecting what? Spot 5? They're expecting spot 5 month over month. If it is higher than spot 5, the PPI was they were expecting spot 5 and it ended up being like 1, right? If it's higher than that, big deal. It's a little dark in this room. Hold on a second. That's more like it. Okay, so let's go through the charts really quickly. So not a whole lot has been going on here. So here's the dollar. Just want to note, yesterday, the dollar was hanging out around that 92 area for most of the day. In the overnight session, it's pushed a little bit higher, but not much. But I'm noticing that the S&P 500 has been reacting to even small changes in the dollar. So that's what we got there. Then when we come over to our volume profile, you can see here things pretty, constrained yesterday, but then once again, a pretty decent spike into the close. Here more recently, though, in the overnight session, there has been a decline coming over into the treasuries. You can see the treasury is pushing down, and we're coming through all of the commodities. Oil flat. Gold and silver are both kind of pushing down as the dollar pushes higher, and copper coming back and stemming its losses. So that's what we got. Okay, our algorithms are on. We got all of our watch lists going. We got the number. Remember, spot 5 is the number they are looking for. Well, I will turn on the text to speech. Super windy today out there for me, so you might hear it in the background. Okay, so it's 0.6. So that is higher than forecast, but not dramatically so. So my little reflex click there was a bad idea. I'm going to say, bail. Bail. So the dollar moving here. Well, the euro certainly moved, but everything kind of stabilized back to where it was. Zero hedge is calling it hot. I wouldn't. Core was spot 3 versus spot 2. CPI was spot 6 versus spot 5. I mean, that's a really high number, though. Damn. Pierre asks, what LG? What do you mean? I'm not sure what you're referring to by that. Are you long? No, I tried going short there, but I should not have clicked that. It was kind of like I saw it move and it was kind of a reflex, but then I heard the numbers spot 6 and I was like, oh, oops. So the thing is like that number is not nearly as bad as it could have been, right? So I do think that the treasuries could move down. We've still got like auctions and all of that sort of stuff today. But I think for the equity markets, they're probably going to read this as good, you know? Like, look at that. That's exactly what they're doing. My nose is really itchy today for some reason. Must be something in the air. See, so it's interesting. I didn't see why we were down. Didn't read that in any of my news, synopsis. But I wonder if we're just going to break back through that. Okay, so I'm going to look at this breakdown now. Energy was quite a bit, increased quite a bit. All items less food and energy, spot 3. So where's the ones that are called transportation services? So one thing I guess we should note then is that particularly for food and shelter, we're still seeing relatively mild numbers. For shelter, it is spot 3. I don't know, guys. I think we've got another case of nobody believes the number is accurate. Hey, Lucas. Transportation services, 1 spot 8, medical care services. Here, I'll show you the numbers here. So shelter up spot 3%, 1.7% year over year. I don't think so. There's no way that number is still spot 3, because the cost of houses, like buying a house or building a house, has gone up like 10% nationwide. And in some markets, more than that, 50%. So that number is BS right there. The only thing that really picked up was utilities. That, Nah, sorry. Yeah, Uzi says particularly in plywood. I think so what I think you're getting is it's coming out. The headline number was spot 6, but when you dive into the crosstabs, it's a lot less than expected. But then you look at those numbers and what's actually going on, and you have to say there's the BLS, the way that they're getting their numbers is messed up right now. ODM is quadrupled. Really? It's definitely crazy out there. With I've been thinking, like, I want to buy build a desk, That's like, I should do it now because it's just going to get more expensive. But then I don't really feel like it. Maybe I'll never do the desk. I don't know. Okay, so equities made a pretty decent move up. They're kind of flattening out now. And the treasury's pushing higher. The daily high would be at 123.21. I'm going to try market making this out, so do as I say, not as I do. No, don't do what I say either. That would be make your own decisions. I don't know. It kind of looks like I would get filled at 20.5 if I put one there. Yeah, I don't. These numbers are all fishy. Okay. Really? 47.89 at 21.5? Some states can't keep sheetrock on hand at all. Yeah, well, I've definitely been reading about the issues with building materials, like that people are just like straight up canceling house building because it's too expensive. It's more expensive to build it than what they were initially built. Okay, well, they're reaching the overnight high here. Oh, future slide after U.S. suspends Johnson & Johnson vaccine. That's what I missed. After 6 U.S. recipients developed a rare disorder involving blood clots. It's the same crap. Oh my gosh. Okay. Surely no issues would come up with the other ones though, right? They're saying a lot of it has to do with the spike in demand in Texas from the freeze and subsequent water damages. I think that the Federal Reserve coming in and saying that that we will get inflation, but that it is likely to be transitory, makes a lot of sense, and is a reasonable theory. But I also believe that the number that we're getting in CPI does not accurately reflect what is going on the ground right now, does it? I mean, spot 6 is pretty high inflation, but when you dive into the underlying numbers, like the amounts for food and housing and everything, is not as high as I believe that it is. And when I've read things about how they're producing those numbers, I don't have a lot of confidence in the number right now. Okay. Well, the E-mini did take a little step higher too, by the way. Notice how it's iceberging right in front of my order. That's not what you want. Here's what happened to public opinion about the AstraZeneca vaccine in Europe after governments paused distribution over blood clotting fears. In some places, it was kind of mixed. That's interesting. They're showing the numbers for the other vaccines went up, and the one for the AstraZeneca went down. Oh, that's messed up. Have one vaccine that ends up being poor, so that the other two can get a reputation gain from it. Man, they're deciding to hang out up there. That was a little too easy. So how much has come in here? About 10K long? I do think that the number, can justify treasuries moving up. Not so sure that they can move up a ton off of that news. And like I said, again, there's like bill auctions and a 30-year bond auction today and stuff. Yeah. Well, the thing that I think is so weird about the blood clot thing is that, like, they already went through that in Europe. And I thought that they had determined what the cause was and all of that stuff. So I'm sitting here like, oh, okay. Trump knocks CNN for completely false report that Gates was denied a meeting. Huh. I'm out of the loop. Is the vaccine thing serious? So apparently there is a certain group of people that have a rare side effect to something in the vaccine that can cause a blood clot. And these guys did a study, and they thought that they had a theory about what happened, why it happens, and who needs to be concerned about it. And so it was like, oh, it's not a problem. But then it comes over into the United States, and 6 people have gotten the blood clot from it. Phlegm it. Weird, the blood clot thing is a problem with people that have the actual virus as well? I've been checking COT data for options. It turns out a lot of their positions are spreading. Well, yeah. Like, you gotta understand, man, that not very many people, not very many professionals are trading this in outrights, because they've basically determined that they can't predict direction or magnitude or anything like that. And so instead what they do is they try and exploit mispricings in the options, because there's so many different things going on there and everything that they can make their model up, and anytime that there's a mispricing, their model tries to exploit the mispricing. And so you end up with holding a lot of inventory and a lot of positions to offset your arbitrage, essentially. Brandon Casey says, did they die? I don't think that anybody died from it, but I don't know. It's going to be interesting. It kind of sounds like it's going to be a public debate about it now. Yeah. LaShawn Murdoch responds to call for Tucker Carlson's firing. Well, review of the guest interview indicates that Mr. Carlson decried and rejected replacement theory. That's not what I heard, but okay. I'm more than happy to wait until this clinical trial is over before I even bother to consider getting that jab. I don't know, man. Here's the thing that bothers me about it all. Is if you've already been sick, they still want you to get the vaccine. And they're basically treating, if you've been sick, like you have zero immunity still. And that doesn't match up with my understanding of the science. Some of those spreads are arbitraging. I'm going to bet you that the vast majority of it is. There's going to be some of that. There's going to be hedge funds, right? So the hedge funds are the ones that are going to be out there and are going to try and make outright calls. Now, the way that they're going to make their outright calls is they're still going to try and take specific risks, right? Like they'll want to hedge away their time risk or whatever. I mean, that's the whole thing about a hedge fund, right? So they hedge themselves against certain risks so that they can leverage themselves really highly to another risk, and that's how they're able to make a ton of money. I just started playing in the Ninja Trader sim account, learning futures price action. I'm not sure if it's a good way to start learning day trading thoughts. Well, I definitely think there's something to sitting, watching the way that an instrument moves, and discovering its personality. But I have never found anything to suggest that just watching the price can effectively predict the magnitude and direction of future prices. So if I'm starting out, what I think you should be focusing on is learning about the instrument itself, right? So if it's the S&P 500, for instance, which is what pretty much everybody does, we should be learning about, like, okay, what is in the index? What is the index comprised of? How do stocks react to certain things? Down through every major economic report that gets released that gets mentioned in the Forex Factory news calendar. How do those news releases affect equity valuations? Right? And that's going to allow you to kind of figure out when something is not valued correctly and exploit it. There are asset and hedge funds that are using options to build positions. Their spreads are for paying. Oh, okay. Maybe. Well, yeah. So again here, yeah, there's a lot of order flow that goes through, and you can kind of look at which strikes have been purchased and everything. But that doesn't necessarily tell you, what it's going to do, right? So this is why, again, I say the reason they like options is because it gives them more opportunities to take advantage of mispricings. Right? That's all just a bunch of information that you can use to see where the market is pricing something at the moment. Man, they really don't like that 21 right now in the 10-year. So the thing here, Kyle, is that, think of it this way, okay? So you're finding a lot of information about how options work and how different types of options strategies work. But the thing that we need to be able to trade that is a empirical edge to prove that we can value something in that market better than the market is already valuing it. Just saw Pelosi exercise the 100,000 Microsoft calls. Well, she probably doesn't manage it all herself, right? That whole game really irks me because, they're required to report their moves and everything like that, but you don't find out about it until like a month after it happens. So by the time you see that information get reported, it's not very useful. They don't need to. What are you talking about? Okay. No, but it's okay. So Kyle is saying they don't need to predict price movement. They just buy strangles and straddles with premium collected from spreads. Yeah, so you got to understand that any trade involves a prediction of some sort. Okay, every trade involves a prediction of some sort. Now that prediction might be that over a long enough time period of taking that trade that it's going to come out profitable or something like that, right? But here in this case, again, what the hedge funds do is they go in and they say, well, if I take this trade and the outrights, There's too many risks and too many things that I'm not able to predict very well. So I'm going to fashion an option strategy that takes advantage just of the thing that I believe I can predict. So in this instance, they don't necessarily know which way it's going to go, but they do think that they know what the magnitude of it's going to be when it does move, right? That's where their edge is. And they're going and they're buying the strikes and so forth that they are, because that's where they see the market mispricing. So they take that, they hedge it, and then they try and arbitrage that inefficiency out of the market. Right? So in order to make money with a trade like that, you have to have an edge to say that this is how far it's actually going to go, and this is how much the option should actually be worth. Right? That's what makes options, that's what makes doing what we do with options so incredibly difficult. Because what we're doing is kind of like, but they don't day trade with these mispricing methods. Well, yeah, I mean, what is day trading really? I don't know. But the point is, there's no free lunch, right? There's no free lunch. We always come in and say, well, if I use this strategy, or I use this stop loss strategy or whatever, then, I'll win all the time. And I think you're going to find that what it always comes down to is there actually a mispricing in the market? So I think that what we should really be focusing on is, what should that thing really actually be worth at the moment? I believe day trading is how one acquires what the kids call a Lambo. Probably not. What is day trading? GME don't hurt me no more. Oh man, GME just got destroyed yesterday, man. I need to go and look at what it was. What it is in the pre-market. So did you see this thing yesterday? Do you remember I came in and GameStop was getting pummeled, and I was like, I bet you that at some point during the day there's going to be an attempt at a bounce, and they're probably going to bounce to the 150, 152 area. Do you remember that? And guess what they did? Very, very late in the day, like in the last 2 hours, big rush up, attempt at the 150, 152 area to the tick. And then into the close, they dumped, and it went right back down. I was like, and I looked at it, and you know what? I probably just got lucky. I tell you what, it's like I really don't see any evidence that we can accurately predict future price movements, but I sure do seem to make some good calls from time to time that seem like they're better than random. But I can't prove it. You go back through and the data, and it doesn't prove it. It could still all just be in our head. They don't need to. Yes, they do. If they're buying a spread of that nature, what they're saying is that the market is going to move more or less than what the market is pricing, and that is inherently taking advantage of a mispricing. Like, straight up, if you make money off of a trade, it means that the market mispriced that. Because otherwise, the market should have known that it was going to go to your target and should have already arbitraged it out, right? They can profit when buying a spread that does exactly not exactly. So now what you're getting into is convexivity, right? So they're going to take a trade where there's a convexivity of it that what they're saying is that this is what I think it should be valued, and I'm going to win most of the time. But there's a heavy convexivity. I believe it's called a negative convexivity to it. That when they're wrong, they just get destroyed. But that is still in order to make money over the long run for that sort of a thing. So you're only looking at it on one trade, right? You look at that over 1,000 trades, a certain percentage of those trades they're going to lose. And when they lose on that trade, they lose a ton, right? And so the amount that they end up making still ends up being the mispricing that they're trying to collect. Well, HF, he's learning a lot about the options, and what he's trying to say to us is, hey, here's a trade that I think we should do. And what I'm trying to say is that trade is not such a great trade for you. Because here again, what you're doing is you're putting on risk, right? So when you're taking a highly negative convexivity trade, where are your edges? Where are you actually making money? One, it's going to be in your ability to price the asset in question, and two, it's going to be in your risk management. So the big issue with trades like that is that when they don't work out, they hurt. So it's not really very appropriate for a small account. Right? Bank of England's Hallandale will step down as MPC after the June meeting of the Bank of England. Oh, okay. Just remember, there's no free lunch. You got to work for it in some place, somewhere. Okay, so Jordan Wiseman tweeting here, inflation data is out and regular CPI is up 2.6% year over year, in large part because prices were dropping last March. So they're even saying that number isn't very high because prices were dropping last year. So the year over year number is higher than it seems. I plan on starting at 5K, not risking more than 2% on. Well, but what is your maximum, like your worst case scenario loss? Is that really going to be 2% on 5K? I'm surprised that your maximum loss is less than $50. You're also going to have to factor in transaction costs in that too, right? Transaction costs can end up hurting a lot more than people realize. Well, the dollar kind of jiggled around there a bit, but in the end moved down, and we're now below 92, which is... yesterday we were around 92 or 91.99. Now we're at 91.94. So we're kind of getting into like breaking resistance areas. It just says it would be nice to hear from you after you trade out, yeah. Well, I don't think so. So Kyle says the thing is that I'm trying to illustrate a scenario which you didn't see before, and you're arguing based on this. No, I think that you're describing an options strategy that is quite well known. Like, that's what I'm saying is like, you're not going to derive edge just from using an options structure that is common, right? Like, I know what a straddle and a strangle is. You can go into think or swim, and there's a little drop down that will tell it specifically to make straddles and strangles for you automatically. He wants to prove it before I risk more. You know, one of the things that I find really difficult about day trading or retail day trading is that the kinds of edges that we can take advantage of is really small and dynamic. You know, a lot of the stuff that I think a lot of where we get our edge from is that there are things that the robots just can't factor in because it changes too much. You know, it kind of takes a human to come in and say, well, here's the piece of data that's being released, or here's the piece of news that's being released, and ergo, here are the correlations that we can see and the mispricings that we're likely to see and that we can take advantage of, right? And so it kind of turns into this thing where it's like you're always going to be into something new. So whether or not you can actually do it effectively is always going to be an unknown. Because every trade is going to be somewhat unknown, right? Because otherwise you would be able to just program it and you could just auto trade it. And you're saying it's about assessing risk differently. So I fail to understand how you're assessing risk differently from everybody else that's doing a straddle. If I had $1 million, then maybe I would think about a strategy like that. You said it's not about the straddle, but are you or are you not going to make a straddle trade? Or a strangle trade? The opposite of it. So they being pretty... New York says appointments for the J&J vaccine will now get Pfizer shots. Intel stock bears losses as Citi sees little competition from the NVIDIA CPU. Oh, I forgot that NVIDIA was talking about making... I really don't think that an NVIDIA CPU would matter, but we shall see. The market opens in about 17 minutes. Okay, well, they did break back through there. Let's see how hard the treasuries come back now. You say it looks pretty impressive. I mean, I guess the thing is that until it releases and we see actual benchmarks, it's going to be pretty hard for us to know how good or bad it's actually going to be, right? Let's make an illustrative example. Suppose we play a coin cost game that you play. When you win, you receive 200, and when you lose, you pay 100. Suppose another game would be getting $50 for every toss. Which one would you choose to play? Well, I don't think you're understanding what I'm saying, Kyle. So let me try and explain. Okay. If we take a simple example of a trade, which is you take a trade with a given profit target, and given the profit target that you choose and the stop that you choose, you will get a certain win rate, right? So here you get the win percentage, and down here is your R factor, okay? Right? You're going to get something that looks something like this, I believe. Right? If this is 1 right here. Okay. So if your win percentage is really high, close to 100%, then your R factor can be really low. You don't have to make very much compared in your winner compared to your loser. Right? So, if you can get anywhere above this curve, and of course 100, this is 100% actually. Let me redo that. Here's 100%. So if you can get anywhere within this curve, right, you make money. Actually, I think I'm drawing this wrong. I think this is something like, I don't know. The curve looks different. I drew it in a different video, okay? Anyways, so what are we getting at? There are some trades that have high convexivity. That is, you win high negative convexity. That means that you can win like 90% of the time, but when you lose, your loser is like, $1,000. The 10% of the time you get $1,000, and the 90% of the time you make like 100 or something like that, right? Okay, so if you come in and you analyze this sort of a thing, so you're saying if your game is you're getting $50 for every toss, but what is the win rate? Right? Because you're saying, I make this trade and they give me $50 up front. Yeah, but if it doesn't work out, you lose money, right? And you lose more than your initial 50, right? And what is the maximum loss on that? And then that comes down to your you use other options to hedge it when things start going wrong, right? No, you're not giving enough information to be able to answer that question. You're saying you use another game where you get $50 for every loss. But what happens when you lose? There's no game where it's just you play and no matter what the outcome of it is, you make $50. I'm waiting. Most of life is winners get 5 and losers lose 50. Yeah. Okay, but what's the win rate? You're not telling me. You say the first game is a coin toss where you receive 200 for every win and you lose 100 for every loser. But what is the win rate on that then? Right? So, if we say that you win 200 when you win 200 for when you win, and you lose 100 for when you lose. Okay? Then I would expect the win rate on that strategy to be somewhere around 33%, right? So let me pull my notes out here so make sure I remember this correctly. So it's going to be 100 over 100 times 2 plus 100, which is 100 over 400, right? Oh, no, wait. 200, 300. 100 over 300, which equals 33%. Right? Why 33% though? Because the market goes, so if it wasn't 33%, okay, so here's the thing. If it wasn't 33%, if the win rate on this strategy was 50%, which would be amazing, then what would happen is other market participants will notice that and they'll start buying it before you ever have the opportunity to do so, and reducing the amount that you can make off of it. So it would either be that you can't get to your target and you never get that 200, or other things come in but essentially it's going to arbitrage it away, right? There's that line, remember? What does the line look like? Freaking, why am I getting all screwy here? Oh, that's why. I got you. It is the opposite. So you get this line right here. Okay. Above here is profitable trades, right? This line here is break even. Okay. So what is going to happen is the market is always trying to move any trade to that. The market is always moving every trade to that. So if you have a trade that you get a 2-to-1 risk reward and you win 50% of the time, then you have identified an inefficiency in the market. And by trading that inefficiency, you are going to reduce it. And you're going to size up, and the more contracts you size up, the more it's going to affect it. So there's formulas for you to determine like what the optimal size that you're going to get in there is. But for a mispricing that big, it's not going to last. Other people are going to find it because that's going to be something that is going to be like really stand out and be obvious to people in the market. That's a really big edge, right? So now you're saying over here let's talk about the other one. You're saying that you'll make $50 for every win and $10 for every loser, and you're going to win 95% of the time. Okay. If you believe that, then I have a bridge to sell you. Okay. It's not going to happen. What's actually going to happen is if your loser, well, how do we, so then we would have to go and redo it. So, how should I? So we want to calculate L here, right? So we know that the probability of winning is 95%. And we don't know L, but we do know the risk reward, as you're saying, that, what was it again? Oh, when you lose, it's 10. So it's 5. 5 times L plus L, right? Because you're saying that the loser would be 50, but it's not going to work out to be like that, right? So then we're going to do 0.95 times 5L plus L equals L. 0.95 times 5L plus 0.95 L minus L equals 0, right? And then you got to do the quadratic formula. First, you take the negative b plus or minus square root 0.95 minus 4 times 0.95 times 5 for AC times negative 1 all over 2 times 0.95 times 5. Okay? Which comes out to... let's do the bottom. 2 times 5 times 0.95 equals 0.9 or 9.5. Four times 0.95 times 5. It's 19. So 0.95 minus 19 minus 1. Okay. 0.95 minus 19 minus 1 is negative 19.5. Okay. So it is 0.95 times the square root of negative 19.5. Okay. Now, class, what is the square root of negative 19.5? Well, we can come in here and we can say, let's see here. Square root of 19.5 is 4.158. Okay. I. So it's actually, I know I'm running out of room here. It is 0.95 times 4.41 I over 9.5. Okay. So you know what I just proved there, Kyle? I proved that your trade is imaginary. It doesn't exist. Yeah, Bill got it there. It's an imaginary number, right? Because it basically violates the formula. You can't go in and have a trade that has a 95% win rate and your average winner is larger than your average loser. It defies what we know about how this break even thing. We know that it comes that the curve looks like this. And you're saying that you've got a trade that's like somewhere way over here. Well, both the games and your example. So if I could take a trade where my average winner was larger than my average loser and a 95%. Okay, wait. He says I made a mistake. Let's. If you want to try first game, 50% coin toss with 200 winners and 100 losers, I would take it, 100%. If I could take a trade like that, my winner is larger than my loser, and I win 50% of the time. Take it every time. I would take that anytime. If you could prove that was actually it. Okay, second game, 90% win rate coin toss with 100% loss profit on winners and 400% loss on losers. Okay, so that's a little different, right? So now what we're saying is, you're saying that it's a 90% win rate and a 0.25% or R factor, sorry. R is 0.25. P is 90. P is 0.9. B is 0.9. R is 0.25, right? Now, I suppose that's profitable, right? Steven says that's the type of strat I'm running. Like, what is like this one? So I think that's still high, right? So if your average loser is, what were we saying? Our loser is 400 over 400 times 0.25 minus 400, right? I believe. Am I getting that wrong? Oh, no, plus 400. Duh. Okay, which is 400 over 500. Which is what? 4 over 5. It's 0.8. Okay, so here's what I'm trying to explain to you, Kyle. If you can go out and you can do that and you can actually win 90% of the time, then that would be awesome. But if the market is being efficient, you will only win 80% of the time. Right? So here again, you're identifying a mispricing. And I would take the both of the trades that you explained, I would take. Or you could take. But then there's other stuff, which is like, do you actually have the ability to take it? Right? Maybe you need more capital than you have, right? Well, I didn't go and calculate like their long-term expectancy. I was just pointing out that both of those strategies were better than break even. Here comes the E-mini. Did come back a little bit more than I wanted. Didn't hit that target. Okay, let's see what Steve's got here. He's got some stats. Yeah. Okay. Yep. But you're running that live, huh? That's 3-1, right? $28. Oh, your winning trade is 9.8. Let's calculate it exactly. Oh, it's 0.35. Yeah, it's 0.35. That's pretty risky, Steve. That's pretty risky, Steve. But if you're getting 80% on it, that's not awful. Your max drawdown isn't bad, but that's not a very large time period either. It's only 4 months. But I got a similar one, right? So Jay, when he's been back tested with that kind of a risk reward, let's see if I can go find the picture. No, that's not it. It's way back there. I think it's like at the top of this one. No, that's not it either. That's not it either. Oh, wait, maybe it is it. Maybe I don't have one. I thought I had a really good picture for him. Oh, that one's the regression channel. That one was funny. Sometimes they do really well. I don't know. Anyways, what was I going to say? The issue with the negative convexity trade is this. Number one, you need a really large data set to really know what the efficacy of the strategy is, because there is always going to be a point where it does really awful. You know what? I've been yapping, and I never got my fill on the downside in the treasury, and I'm not paying attention to it, and I think I should just stop on that one, right? Because when it was coming back up, I should have been managing it. What was I going to say? Oh, yeah. So you need to really... So the problem is that you might not come across the time period that will kill the strategy for multiple years, right? So you got to have a back test that goes back, a couple of years if you can. And then the whole thing is going to be that your risk management is going to be a really critical factor, right? Because what blows these strategies up is the market kind of figures it out and will just hit on exactly that thing that you're doing. It's really bizarre. Like, you go back and you'll do a back test and you'll be like, okay, here's how it performs. And yes, it's like a high convexity trade, but I've never run into a period in 10 years where it's ever really had a significant drawdown, right? And then you're going to start trading, you're going to size it up to be the appropriate size, and the market's going to notice, and they will find exactly the thing that will screw your strategy up. You know what I mean? That's the issue with that one. So, and the drawdowns can be quite severe. So, most retail traders can't trade that one because the drawdown will be bigger than their account. But it can be done. I'm not going to say that it's not going to be done. I'm just saying that for most people, you're probably better off looking for something else. Because the edge that you're really taking there, it really comes down to that you're taking on risk, right? Your average loser is larger than your average winner. So your edge is taking on risk. Okay, well, they're kind of coming back on us a little bit. Why is that my stop there, by the way? That's kind of... Oh, that one was my other buy order. That's why. Durr. Durr, 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 durr. It's almost a conspiracy after you find the magical system, quote unquote, they take your money. Well, it's not a conspiracy. It's just the market seeks out and eliminates inefficiency. And if you are taking on if you're a strategy taking on high risk, eventually it's going to come after your weakness, which is the risk management, right? It's like, yeah, on average it works out, but what's going to happen when your system loses 20 times in a row, right? Well, if you have a strategy where your winner is 10 and your loser is 10 and you lose 20 times in a row, then you lost $200. But if you have a system where you win 10 and you lose 20, then you've lost $400, right? I'm thinking back on all of that math that we did in the quadratic formula, and I'm pretty sure that I must have made a mistake somewhere in there. I do not trust my algebra on the fly that much, but I'm sure somebody's going to come back and watch it on replay and be like, "Oh, you're so dumb. Look, you made this mistake." $1 million account is a good edge. Yeah. So this is a different issue. So you're hitting on something that I think that a lot of retail traders believe, but they don't completely understand the implications of it, right? Because this goes back to the impact, execution impact. So if you have $1 million account, then in order to make a good return on your profits, you have to take a large enough trade that you're going to have an impact on the market. So you come in and you buy, and people will say, "Oh, well, you buying will make everybody else buy, and ergo, it will move it up for you." That's true. It does. But then when you sell, they will also sell and they will move it down on you. And what we have found is that particularly on short time frames, that sell ends up having more impact than the original buy does. And so on net, you lose money. And so execution impact, it seems like it would be an advantage, but it is not. And this is why you get all of these hedge funds, for instance, and they say, well, this hedge fund, they basically like underperform the market a little bit, right? Well, what happens is they'll have a strategy that actually does work. They'll have a strategy that totally works, but the execution impact ends up making it so that they underperform the S&P 500. You get what I mean? So there are some of these strategies that you could, if you were sophisticated enough to duplicate and you just did it on a teeny tiny account, you would probably make money and they wouldn't, right? So there's an issue in that. But you could come back and look at it from the perspective of like you got a win rate and you've got a risk reward ratio, right? And we know that based on what your risk reward ratio is, the market is going to try and arbitrage the profitability, the percent profitable that you get to break even, right? So how do you find an edge? What I say is you take a certain risk reward. That's going to have, so let's say that our risk reward is 2-to-1. So we're going to expect to have a 33% win rate, right? But what if we have something that dramatically increases our win rate? Okay. So what are some things that we can do that we can use to dramatically increase our win rate? Well, one is that we can utilize the Q. So if you can get a good Q position, then you can dramatically increase your win rate because you can, like, if you get a toxic fill, you can just turn around and sell it back into the people and break even, for instance, right? That's an edge that we know of that will straight up increase your win rate, right? Or what if we only take that trade in situations when there is news going on and we know what the market is going to do based on the news? Then that could increase our win rate, right? Or maybe we have a technical setup that we know has a probability of increasing the win rate. Well, I've never been able to find that one, but I'm not going to say that it doesn't exist. Could exist. That could increase your win rate, but probably not. You get what I'm saying? Or maybe you know of an arbitrage. You know that the value of this is tied to the value of this. And because the value of this thing just went up, the value of this thing should follow it. And so that's something that could increase your win rate, right? So that's where I'm saying that's where you should really be looking. So you can come in and you can say, here's a trade to a structure that has an 80% win rate and your loser is 4 times your winner or whatever it is, right? Or back up. We'll go back to the numbers that we just stated, right? It's a 0.25 reward factor in an 80% win rate, okay? But then we come in and we only take that trade in situations where we have a predictive edge on it so that we can get that win rate from like 80% to 85%. Okay, cool. Right? But here's the thing is, does that going from 80% to 85% matter as much as if you've got the high risk reward trade where, you can come in and like normally you'd get 30%, but you're able to make it, you normally get 33 and you're able to make it 40%. Guess what? You're going to make more on the other one. That's why I say that for a retail trader, it makes a lot more sense to go for the good risk reward trades. Or we just buy Bitcoin every day without technicals if it grew says 60K is over goodbye. They're going. I'd say that the price action in Bitcoin looks pretty good now that they're over 60K, right? I mean, I've been saying for a while that they're likely to push through it because they're not showing any signs of exhaustion, even though they're crazy overvalued. And yeah, they busted it. There's kind of a possibility that once the euphoria of passing 60K is over, that it flips back on it, right? It looked like a cup handle, yeah. Well, I've never seen, and I'm not going to say that this is predictive of future price action or anything like that. Bitcoin's got this convexivity issue too. Like it seems to react really well to technicals until it crashes, and then all of a sudden it's like, what the heck? What's it doing, right? But I've never seen Bitcoin where they consolidated right up to a level and they didn't take the level out and push further, It always, when it turns around, it's always in an exhaustion top. Until it's some weird time like Sunday morning. I wonder what my Bitcoin valuation indicator is going to give us tomorrow. Because they have been building up on the volume, but yeah, I don't know. Tesla, that looks like it's picking up momentum. Tesla's been doing really well lately. Either way, what do we got on the top? It looks like corn is up 2.5% today, so way more than they lost. And gold is up too. Yeah, I didn't even really care to pay attention, but the dollar getting creamed has really helped gold and silver out. How much is silver gone? Oh yeah, it's not bad. Up at 25 in the silver. Wait, where does that put them at over in here? Well, this is not quite there. I think if silver were to break 26, maybe, that could be a spot where it could be like, oh my, I think everybody wants to buy it now. And Tesla's still in that 700 area though, right? I'm thinking back on the treasury thing, and I was like, okay, so I screwed up on the first trade, And then I said, well, let's just market make it and see what we can do. Market making against the action. So I knew that I was against the action, but I'm thinking back on it now, and I'm like, why did you do that? That was so dumb. So when you guys were talking about that $1 million account, and then I talked about market impact, you guys really quieted down, and Vlad took over. So was there something I said about that was like, well, I don't know what's going on, and why did you guys go quiet after that? Why is it that anytime we talk about the execution impact, that everybody goes quiet? I don't know if it's like people don't understand it, or there's just nothing to comment about it, or they don't believe it, or they don't see why it's relevant to them. Would like to see people get more excited about talking about execution impact. Maybe we wish we Bill. Yeah, that's exactly it. Makes sense to me. We're lucky not managing huge. That's exactly it, Stephen. I mean, that's kind of the point that I'm trying to make here, is that you as a retail trader have a big advantage by being small if you have something that actually gives you a probabilistic edge. But the structure of the trade is usually not going to be it, right? Having it that you make a lot on your winners or losers, or you have a high win rate overall, that's not the thing that's going to give you the edge. The thing that's going to give you the edge is you have the trade structure, but then when you're taking it, your win rate is going to be higher than what it should be if it was break even. And if you're a small guy, you can take advantage of that. But then how do you get that actual edge? Well, if you get in the right spot in the queue, well, the robots are too fast. The robots are too fast to get that one, most of the time at least. There's some instances here let's keep an eye on this 10-year here and see if we can get the one ticker. I had already gotten it a couple of times while I was trying to make it out, but let's see if we can get the one ticker in there, because that's what we really should be focusing on in the treasury. But most of the time, you're not going to get your spot in there. Okay, news. It can be, but sometimes you still have to be fast, and sometimes you just don't understand what's going on, right? And sometimes you're stupid. Today I understood what was going on. I made the right trade in the E-mini and not in the treasury. I didn't know what, because I made a mistake. It's like you make a mistake and sometimes your brain just turns off, I mean, it was not a live account. I don't think that I would have done any of that if it was. I don't think I would have even done that initial click if it was a live account. But I digress. And here's the one that I'm just throwing the idea out there, okay? But I know this sounds really crazy, but hear me out. Maybe we can look at the value of instruments compared to the value of other instruments and find situations where one is undervalued or overvalued compared to the other one, and just take out that teeny tiny little mispricing. And because the mispricing that you could get could be different every day, it would be something that would be very difficult for robots to program for, and it would be such a tiny amount that other people wouldn't want to be taking it. And since retail traders don't mess with that sort of a thing, there wouldn't be a lot of competition. And then you could probably get the best of both worlds, right? You have something that's equal risk reward trade, but a high win rate. If you actually find the inefficiency. Well, the E-minis approaching that high. They're like 3 ticks away. A little bit more of a dip that I wanted. I didn't necessarily want to swing this, but Google shadow bans searches for riots today following violent unrest in Minnesota. Okay. How high? Well, so let's come back here. Come back to the 10-year treasury. Oh, so we're back into it. So yesterday's high was 28.5. And how has the spread? So the spread is steepened on the long side, but on the short end of the curve, it is flattened. Is that just because of the 10-year? No, it may be just because of the 30-year. Because of the auction. Maybe. Do you get what I'm saying here? The spread in the ZB is flattening because, well, that means that the ZB went up more compared to this one. I would need to look at more spreads to completely figure out why it's doing that. Do you see how, like, if we just go back to the open, the 10-year has moved more ticks than the 30-year has? When normally it would be like ZB went like way more. So it's like the 10-year is moving really good today, and compared to some of these, I don't know. I haven't seen them diverge like that in a long time. Let's see what the guys in the interest rates channel say. Oh, by the way, I'm just thinking in the 10 year, what was the lowest that it got? 18.5. Wait, why didn't I ever get? Well, that's really confusing to me then. Bitcoin keeps pumping. The tether issue is not resolved. I'm telling you. Everybody in the crypto sphere is functioning off of something that is not true. They say that the Bitcoin issue is the tether issue is resolved. So then, when is it? June 1st comes along, and the tether reserves come out, and it turns out that there's not dollars there, and that if everybody decided to go and redeem their tether today, that they wouldn't get it back. That's what would happen. Like, that's my claim. If everybody today tried to redeem their tether, they wouldn't be able to get it. Straight up. And I'm not just saying that's like a theory of mine. That's like a straight up fact now. Okay. Because they've come out and they did their attestation, and they straight up said that it was being backed by digital assets. So it's not dollars. It's not liquid. That means that when they would have to liquidate stuff to get it out, and it would not equal the amount of tether that they've issued. That's a fact. So what's going to happen is May is going to come along, and we're going to find out how much of it really is backed and how much of it is not. And it will basically expose that it's a fractional reserve, right? And I'm going to bet that the Bitcoin people don't care. Which is kind of messed up, isn't it? It's the same with the banks. If everybody wants their money off the bank cannot handle that. Yeah, in many instances that can be true. We have controls in place to protect people's savings in instances when there is a run on the bank. But you're right. We have a fractional reserve. But the thing is, Bitcoin was created to get us away from that, and they have created a system that is worse than the one that they were trying to solve. What use is Bitcoin? How is it a hedge against inflation and against the US dollar and all that sort of stuff if they can just print money? Explain that one to me. That don't make any sense. And I'm not speculating here. We know from Tether themselves that it is not all dollars. So, but here's the thing. It's an overpriced digital abacus. There you go. Here's the thing. By the way, I got my fill in the E-mini. That's good. So I did good on that. I mean, the trade that matters is usually the E-mini. I don't know. Does anything matter anymore? I'm getting too existential. Anyways, I don't think that any of the people that are investing in cryptocurrency really care about any of that stuff. I think the only thing that they care about is that it's going up. Right? And this whole, it's a flight to the dollar thing, even though that's objectively, that's based on information that is objectively not true. They're not going to care. So when it's going to be exposed and it's undeniable anymore, everybody's going to look at it and they're going to say, listen, only X% of this thing is actually dollars. Okay. Because honestly, think about it. Do you think that Tether has $33 billion sitting in a bank in the Bahamas somewhere? I'm telling you, they don't. They don't. Most of it has been reinvested into cryptocurrencies. They print the tether and then they buy their cryptocurrency with it, and then they back the tether with their cryptocurrency. So if they have to sell the cryptocurrency, it's not going to come back. It's not going to be equal to $33 billion anymore. It's not even going to be worth $1 billion. I thought 20K would be the top. Wow. I mean, this is the thing, is like, I can tell you that it's overbought. I can say that it's turned around when it's reached this amount of overbought in the past, but that doesn't mean that it has to do it in the future, right? It just means that once it gets past that point, the risk is not worth it, you know? I don't know. And you have to consider, given how much of that is probably not real, what kind of disaster it's going to cause when people finally, you know, when it stops going up, essentially, right? It's deflationary. So when you get to the point that Bitcoin stops going up, it's going to be a real disaster. I mean, it'll be way worse than 2017. So Alligator went and took a look at his spreads, and he says on the action that we've seen, he's not sure if it's significant. It may just be a temporary anomaly. And I'm thinking, well, yeah, but I think I kind of want to take advantage of that anomaly. When COVID is controlled, I expect big dumps on tech and BTC, question mark. Well, I don't know. So here's a story. Here's an interesting, we should have talked about this earlier. We haven't talked about it. I'm doing terrible today. Can I tell you? Can I just rant about that for a second? Wasn't very organized when I came in. And then off of the news, I kind of reflexively clicked in a trade that didn't make sense at all. And then instead of just like leaving it alone, I said, hey, let's try market making against this move. I was like, why? I mean, I guess it's an interesting exercise, but the reality is that you've got to like that push down. I think the mistake that I made was that it pushed down and it did fill my order, but I should have been dumping it all down there. Like in the 19 area, I should have been getting it all out and taking the loss, whatever it was. It looked like my average was up to 21. It said that my average was to 21.5. And I thought that I had everything. So I don't get how I missed that. But I was talking then. So whatever. So I'm mad about that. I'm mad at myself for that. And then, you know, we blabbed a long time. But we got the E-mini trade, $50, so that's good, I guess. But that one over in the E-mini, like I go and I look at the E-mini, I'm like, yeah, I'm doing great. I buy it, and it goes up. And that one's not going to last. Soon as, like you were saying, so now let's talk about the thing. So yesterday, one of the Fed speakers, I think it was Bovic, I forget the guy's name. Anyways, he said that he thinks that the time to start thinking about tapering, and when he says tapering, he means like reducing or eliminating the purchases, not changing the interest rate, but the purchases would be when we're like to herd immunity, when it's like 75% of people have either had it or had the vaccine or had the disease, right? Well, that's a big change. That's something that he shouldn't have said, essentially, because now that's kind of a benchmark. Now everybody's thinking, oh, so when we get to 75% herd immunity, which is in 2 months, by the way, presumably, I mean, this Johnson & Johnson thing might affect that, but we get to 75%, they remove that stimulus, and that wouldn't be very good for the markets, would it? So then you get into what Jay Constant is saying. When COVID is controlled, expected big dumps on tech and Bitcoin. Maybe it could happen. I'm kind of the opinion that Tether is going to continue printing like this and continue to push the price up until they can't anymore. So when can I go short? I don't know if I can. You know? So Jenny Constant says we're still in lockdown here in Holland. Gym's closed for almost 1 year now. Yeah, that's crazy. Well, Europe hasn't been handling it as well as the United States for whatever reason. But the thing that you got to remember is that the recovery from here on out with COVID is going to be very regional now. Some places handled it and got the herd immunity better than other places. So there's going to be, and some places have warmer climates than other places. So you're going to get some spots that it's basically done. Texas, Florida, it's basically over. But then there's other spots like Michigan that are just doing absolutely terrible. And it's kind of funny that some of the places that are doing the worst were the ones with the most severe restrictions. So you can go short when J Powell says inflation is satisfactory. Well, now that's an interesting point too, though, which is if we come in and we say that the Federal Reserve removes its asset purchases, that the economy will kind of take a dip and that some mispricings will have to come back, then will you ever get to the point where they really need to raise interest rates? Not for a really long time. Not for longer, like they were saying 2023, and then it's going to be like, no, they're not going to increase interest rates until like 2028, you know? That's where that could lead to. The USA has much more COVID cases and deaths because they want the economy to thrive. Everything is closed here. Yeah, well, listen, there's consequences for everything, and I think that if you're just optimizing for just that one factor, which is, you know, number of COVID deaths, that's a little short-sighted. I just need a video card. This is ridiculous, Vlad. I tried to get in on the Newegg's lotteries just to see if I would win. I guess I don't really want to spend money on a video card right now, but I did get I did go in the lottery and I didn't win. I think it'd be really hard. The number of people that want new cards, it's really high. Old methods of bribing people to get one probably would be equal to what you would pay if you just paid the exorbitant prices that people are asking for, you know? So here's my spot. Average USA did terribly under Trump. Well, like that's where it's like you kind of have to look at it over the whole thing, right? So first of all, nothing's changed under Biden. Just so you know, this is one of the things that just drives me crazy, man. So everybody acts like, oh, Joe Biden, now it's fine. It's all Joe. But no, they didn't do anything. They came in and they used the same plan that Donald Trump already had. They didn't implement Donald Trump's plan very well, but they renamed it and they changed all the people. That was basically all they did. See that? That's what we want right there. Yes, sir. We have along at 25. There are 3,000 people in line. Oh, but they sell it right away? So that right away is like, no, that's not what we want. I bet you I could still get filled at 25 half. But they're playing games with me now, right? They're 3,000 behind me and then it just disappears instantly. Ouch. Jay Constant says yes over the whole thing, and of course, Biden. Yeah. So I remember when this started and the U.S. was having, oh my gosh, 24 half. See, am I getting screwed here? Maybe I just can't do this in the 10-year, man. Just the fact that Biden wants masks and Trump didn't say more than enough. Yeah, but then you kind of got to wonder, how effective are the masks really, right? I feel like that the 10-year treasury is doing that just because I was like, this is what we want. Look at that. We got our long at 25. We've got 3,000 on the stack. Like, it was perfect. And then they go 3 ticks against us. Excursion. What the hell? The 5-year leading him down. It looks like the 5 years might come back up. So I might get away with this, but that was a bad. But I remember early in the summer, and everybody, and it was like the U.S. was doing poorly and the Europe was doing well, and I was like, just let's wait until the whole thing is over to say which country did the best, right? Which means that it's still not over, really. Frankly, it's still not over. Like, what if there's another variant comes along, or so, you know? You would say 32 million cases around. Well, and that's it. So the other thing is, remember the whole New York thing, man. Right? It makes me so mad that nobody talks about the mistake that New York made, because that's like why it happened, and it really kind of moves the thing. So I saw this survey the other day. It makes me mad. Like it straight up makes me mad. They were asking how afraid people were of coronavirus, and Gen Z was more afraid than the older grade age groups like the millennials and Gen X. Can you believe that? The people that are most capable of it surviving it and it not being a big deal are terrified of it. That says to me that we pushed a line about this pandemic and that people were not informed. People were not informed, because the thing that matters the most is protecting the vulnerable, which is like people over 65 years of age. And that's why in New York they had so many deaths, because they let it go in through the nursing homes. Right? Just absolutely a complete travesty. Because it's some, like, it's the vast majority of them are old, you know, or like in their 70s. So yeah, since we use the mask, there are almost no flu cases. That or flu cases are just being misdiagnosed, probably more likely, but. Okay, so now we're in the situation where we're like, okay, look, we could, okay, and look, that time they hit it a little bit and they absorbed some, so that's cool. Not getting the buys, though. I think that the mistake I made on this trade was that there really wasn't enough flow for me to be doing it. I don't know. You're saying that it just so it does something. I don't know if that proves it does something. Like, I think the issue with the masks, or at least what I suspect, is that even though it dramatically decreases the spread of it, that you move the needle this far, you still get a breakout. You know what I mean? Because I think the issue is more so that if you are in a vulnerable age group, and you catch it, you're gonna die from it, you know? And so even if the transmission rate is like, 50% less, that those people that are going to die if they catch it still catch it, right? Like the amount that you have to reduce the spread to really truly save those people is like you have to have the full lockdown, right? Mask does work. It's proven. I mean, not exactly, right? It's been proven, like the science that I've seen that's proven something is like if you sit there and somebody coughs and they have a mask on versus they don't have a mask on, less virus particles are transmitted. Yes, that's true. But do masks make like the number, like the death rate to COVID and all of these other like metrics that we're looking at on a national scale to try and judge how effective their coronavirus response was? Does the masks affect that? And we haven't been able to show that is the case. There's so many factors involved that you can't show it in the numbers. Right? Less cases, because some of the places that have the most cases were the people that were most adamant about having the masks. So I think, and not only that, but like you can go and look at like there's all these charts where it's like, okay, here's like the spread, and be like, here's the number of cases as it went up, and here's when they implemented masks. So it's like, okay, so can you see from that data set alone that masks work? No, you can't, right? It'll take years before I think we can answer those questions. All I know is that they're really uncomfortable. Mm-hmm. Yeah, Stevens, Colorado says population density and climate seem to play a role for sure. There's lots of things that play a role. So, wait, what are you saying about 4,900? Oh, I do see that now. Huh. When did that show up? Without a lockdown and no masks, hospitals would have been overcrowded. Well, it depends on where you're talking about, right? And the thing is that it seems to me there's a considerable amount of evidence to suggest that full lockdowns do work. At least when they shut down for 2 weeks, like that original 2 weeks, that definitely did something. Okay. It's unclear what kind of effect masks have. But then there's also this other thing that the lockdown, like an extended lockdown, like trying to keep people locked down for a year, which is what has really been happening in some places, is not a no, that doesn't appear to be a good idea. I also personally believe the whole thing about herd immunity, I don't think that it's a crazy theory. I don't think that you come out and you tell everybody, okay, like go and get it. No, but I do think that People that are truly healthy and low risk should be allowed to live their lives. And you should tell everybody to be cautious. But I don't think it's necessary to keep those people locked down for a year. I don't think that helped. I think that the United States is doing better and recovering from the pandemic faster because we weren't locked down for most of the summer. And so we developed some amount of herd immunity during that time, whereas in Europe, they've got practically nothing. And then you add on top of that in Europe, they've had a hard time getting the vaccine out. And, so then it kind of becomes this weird thing because we would talk about which country did better. Well, then it seems that whether or not they did masks or how much they locked down might not matter as much as how the vaccine, But then that just kind of begs the question, in a future pandemic, does it really make sense to shut your country down and wait for a vaccine? I don't know, man. I think that a lot of world leaders, if they go back and, they do all of the full analysis and then we go back and we do this again, they're going to do things differently, right? What's this? Oh, Kyle just posted another picture. Yeah, Kyle is saying that those two games, the expectancy is the same. I would take the first one. 100%. Comes back out. We can get people to hit 25 half. 1, 2, 3. Okay. Yeah, I'm looking at this thing that Kyle was saying in the equity indexes channel, and I'm telling you, I would still take the one that has the better risk reward. No, I don't necessarily think that the volatility is an issue. So he's saying that because this one you would win like this, and this one you would win like this, that you'd rather have this one that's more consistent. Theoretically speaking, yeah. Something that has less volatility tends to be better. But the thing that I don't think that you're considering here in this is how are you getting those results, right? So if you are getting those results because you're taking on more risk than your reward, right? There is an inherent issue with that, right? It makes you vulnerable. And I'm not just talking about the risk of ruin. I'm talking about with the way that the market works, it comes after it. So, so think of it like this, okay? If we have the S&P 500, right? And we have a day where the S&P 500 moves like this. Let me clear it out. Who's listening? Okay, so you have a day in the S&P 500. Well, both of these days have the same amount of volume. Okay, one day it's going like this, and one day it goes like this. Okay, which day do you think that we can put on more size? So where is that? Let me go find it. It's 8:30. Still got about 30 minutes left. No. Are you a fan of Dan Bina? Dan Bina says Bitcoin will go to zero. I've never heard of him before. I do think though that like you can have in a short term Bitcoin could go like really really high, but I think that there's going to be a point that will come where not many people will want to touch it. That it will be for all intents and purposes dead. Because it will get supplanted essentially. Like the issue is right now is that there's going to be a point at which if things go well for them, they'll get so big that it won't work anymore. You won't be able to get any orders filled. So then they're either going to have to change the protocol and increase the block size or, deal with the logjam and eventually become irrelevant. You know what I mean? Anyways, so where was I was coming over here and I was trying to find you something, Kyle. It was not this one. It's This one. It's so interesting that you say, just call me Kyle. Because the guy that taught us this, that was able to, that we found out how this works, his name was Kyle. Okay, actually, I gotta open it up twice here for you guys. Ding, 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 ding. There we go. Oh, I forget what that symbol. Oh, there it is. Volatility. There it is. Okay. It's actually a little bit further up here. So they're talking about, okay, how many contracts can you use? What's the optimal number of contracts to use? Right? Say optimal number of contracts is equal to 1/2 the price difference that you're trying to make over Kyle's lambda. Okay. And what is Kyle's lambda? Kyle's lambda is equal to, this is right here is the volatility over 2 times the geometric mean square of the volume. Right? So that means the larger this number is on top, the greater the impact is, right? Like if they were just to do an example, if this 2EV was 4, if this was 1, if the volatility was 1/4 versus 2/4, right? The higher this number is, the greater the Kyle's lambda is. But on the split side, so that's the Kyle's lambda bit. But then you come up into here, okay? The pricing difference, so 1/2 the pricing difference over Kyle's lambda, right? So here's the thing. You can't control that. That is just, the market is what it is, right? But you do control that, right? You know what your target is. The larger your target is, essentially, well, the smaller your target is, the more scalable it is, right? So in reality, what you want is, you want something that's, the more scalable it is, it means smaller trade, right? Better risk reward. So if you have a trade that you can get equal risk reward and you can win 70% on, that's better than something that you win 80% on, but you have an R factor of 0.25. You had strategies where you got a 50% win rate. Yeah, I found some where you get a 50% win rate. Takes a little bit of an edge to get to 50%. And the risk rewards on those are equal. Finally filled. Well, I think that trade was pretty sucky. See, this just comes back to the same argument, man. No, I don't think you understand. Wait, what? Clark says, I remember say they watched Watt and they were marking on his position, want to try something, so he casually added 30K or so to his account. Like most people, I assume, starting out and whatnot, cannot just do stuff like that. I don't think that would be a live order. Tesla up 5% now? Wow. Well, I'd say the E-mini had a pretty good run here, but they're only just back to where they were like the end of yesterday, a little bit higher. I don't know. So I think what's going to end up happening here now is we're going to get into the earnings season, right? And I think that most of the earnings are priced in, but the forward guidance, we'll see. I think that there's a little bit more risk here than there has been in the past. A downside risk. How Chewy gets offside sometimes too. Yes, he does. Good grief. That guy's gotten awfully lucky. So how do I put this for Kyle? Here's what I think you need to do, Kyle, because what you're doing is you're looking at like, okay, here's just the expectancy and here's the volatility of what you get, assuming that you have two equally profitable strategies, right? Okay. Now, what you need to ask yourself is, what is the actual edge in both of those strategies, right? So both of those are pretty great strategies. Okay. If you're actually making those numbers, that would be amazing. Okay. So I think they're not very realistic, but let's just assume that you're getting it. How are you getting it? Right? That's the thing that you have to consider. And then once you get into that point, then you get into the things that are like, what are the risk rewards to those? You know, what is like the maximum drawdown for that sort of a thing? What are the things that are going to make that trade stop working altogether? Right? What kind of conditions will it work in and not work in? Right? And this is where I'm saying, when you take the high negative convexivity trade, the primary edge that you're deriving in most cases is from simply taking on risk. So the easiest way to have, the easiest way to have a year of profitability is to just take on excessive risk. You'll see this time and time again. People that take on excessive risk seem to be doing well, and then they'll blow up, right? They'll make it like 2 years, and then they'll blow up. Whereas if you're getting this thing where you don't win all the time, but when you do win, you're catching 2-3 times your winner. First of all, your edge is not taking on the risk, right? Because your risk reward is positive. It's higher than 1. Also, if it's a purely technical signal, you're really truly identifying an inefficiency in the market, right? But the downside of it is that you don't win very often. It's really grueling. There's these sorts of things. Now, there's this other side to it, which is like, okay, if you're using the high negative convexivity trade, in order to get 90% win rate instead of 80% win rate, you still have some sort of edge to some extent. Okay. It's maybe not necessarily predictive, but it could be. It could be that you're adding something predictive. To get from 80 to 90 is a lot harder to get from like 40 to 50%, right? The higher your win rate is, the more energy you have to put in to increase the win rate. But one of the ways that you could make a trade like that would be like you're playing the queue, for instance, right? So that's really competitive. So this is where you get this other issue that like these high negative convexivity trades have a lot of competition for them. So that's why they have a tendency to blow up. And it's not just that it's like the Kelly criterion, right? I'm saying the way that the market behaves is a period will come along that will actively target your strategy and take it down faster than any of your stats say that it should. But that's the whole point. Mm-mm. Well, I can continue with him on Discord after the stream, so I guess that's okay. Yeah, I don't know. I'm still like really weirded out by what I did there in the treasury. Why did I do that? Gotta think about that. Why? What was I thinking? Well, I did kind of come in and think like, it can't go that high. So I guess it went a little further than I thought. But why should I be making that kind of a judgment? I only know it's going up, right? There's another thing that we're not considering in here, Kyle, and that is that with an option strategy of that nature, you don't have complete control over how big your loser is, right? Right, and you put the stop loss in. Well, I better get going. I'll message you in Discord. Anyways, sorry. I guess I was a little boring today because it was a little bit sparser viewing today than normal, but I gotta get going. CPI data comes in hot. But not. I'm just gonna say that it comes in hot, even though I know that like the whole thing was that it wasn't really all that bad. But anyways, stay profitable.